Legendary hedge fund manager Paul Tudor Jones believes financial markets have reached a point almost identical to October 1999, just months before the dot-com bubble burst. His warning is simple but chilling. Investors are dancing on the edge of euphoria, just as they were at the turn of the millennium. Back in late 1999, the Nasdaq was exploding higher, fueled by tech mania, easy money, and unshakable optimism about a new digital era. Every dip was bought, every warning ignored. A few months later, the bubble imploded, wiping out trillions in market value. Jones now sees the same psychology repeating in 2025. He points to the mix of massive liquidity, stretched valuations, speculative leverage, and blind faith in technology as eerily familiar. The entire market structure feels unstable, built on hype rather than fundamentals. Yet, he admits, there may still be a short burst of gains left before the music stops, a blow off top, as traders call it. According to Jones, that final euphoric phase can be extremely profitable for those who play it well, but it can also destroy those who stay too long. This is not the first time he has warned of excess, but his latest remarks carry weight because they connect so closely to history. In 1999, markets surged from October to March, driven by speculative momentum, before collapsing spectacularly. Jones argues the same setup exists now. Ultra-low real rates, huge fiscal deficits, and an investor class addicted to risk. Every correction has been shallow, every rally stronger than the last. The optimism is blinding, the complacency near total. He describes the present moment as a dangerous blend of fear of missing out and institutional pressure. Fund managers are forced to buy into expensive tech names simply to keep up with benchmarks. Retail traders, armed with margin and social media conviction, are chasing whatever glitters with the word AI. Corporations are buying back shares instead of investing in growth, further inflating valuations. The entire structure relies on belief. Belief that liquidity will never run dry, that profits will keep expanding, and that central banks will step in if anything breaks. Jones doesn't deny the possibility of one last spectacular rally, but he warns that when the turn comes, it will be sharp and merciless. Just as in 2000, markets could swing from extreme greed to panic in weeks. For investors, that means caution must replace complacency. He stresses the importance of positioning, risk control, and the discipline to take profits before the crowd realizes the game is over. The parallels with 1999 are not limited to valuations. Back then, technology promised to change everything, from business to daily life. Today, artificial intelligence plays the same role, a transformative story driving speculation far beyond reality. Companies that have barely integrated AI into their operations are seeing their stocks soar simply because they mention it. History rarely repeats perfectly, but the rhythm feels the same. The deeper message behind Jones's warning is psychological. Markets collapse not because of a single event, but because belief suddenly evaporates. When the illusion of endless growth fades, liquidity disappears, and sellers outnumber buyers. That's how bubbles burst. He suggests that this cycle may already be in its final phase, one driven more by narrative than by numbers. For long-term investors, the takeaway is clear. Enjoy the gains if you must, but keep one hand on the exit. Markets thrive on momentum, but momentum can reverse overnight. Protecting capital matters more than chasing the final percentage of a rally. Jones has built his reputation by recognizing these inflection points. His comparison to 1999 is not casual nostalgia, it's a direct warning. When one of the most successful traders in history says the market feels exactly like the months before the dot-com crash, investors should pay attention. If you found this analysis helpful, hit like, subscribe to Financial Vlog for no-fluff insights, and turn on notifications so you never miss our next breakdown on what is really happening beneath the surface of the markets.